Precious metals continue to show strength and buoyancy about 10 days after the Federal Reserve admitted it is ready to again cut targeted interest rates to potentially accommodate slowing economic conditions. The spot gold price has cleared and remains above the 1,400 fiat US dollar price level, closing the week around 1,410 fiat dollars per troy ounce. The silver spot price is closing the week around $15.35 per troy ounce in fiat Federal Reserve notes. The gold-silver ratio has again climbed, closing the week close to 92 ounces of fine silver to afford 1 troy ounce of physical gold bullion. This week, our returning guest, Christopher Aaron of iGoldAdvisor.com, takes us through some past moments when overly optimistic precious metal viewpoints got crushed. We juxtapose some of his fundamental and technical analysis work, overlaying it to today's technical and fundamental backdrops for bullion, precious metal-related investments, and even the future of the broad commodity complex in general. Stay tuned for our conversation and some of Christopher's analysis coming up right after this brief word from our podcast sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. We are committed to being your trusted source for low cost, highest quality investment grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SDBullion.com. The following interview is being recorded 3 p.m. Eastern on Tuesday, June 25th, 2019. The silver spot price at the time of this discussion is about $15.40, while the gold spot price is currently hovering around 1,425 fiat US dollars per troy ounce. The gold-silver ratio, which we'll be talking about here in further detail, is at a new 30-year high mark of just over 92 ounces of silver to afford 1 ounce of gold. With us this week, a returning guest of the show, he is Mr. Christopher Aaron of iGoldAdvisor.com and iGlobalAnalytics.com. Christopher, it's good to have you back on our podcast.
James, thank you so much for having me.
So, Chris, you brought along some charts and some slides that we can go through with our audience. But before we do that, I wanted to, bring on a couple of ideas because there's going to be some doubters. Obviously, anytime you talk about technical analysis and you bring in, various people in the stacking community, a lot of them don't want to hear it. They don't really think technical analysis is valid. And so maybe we should start with that. What's your view on technical analysis and perhaps what are some of the common doubts and perhaps rebuttals to them?
Yeah. That's great. Thanks, James. So first thing I just want to say off the bat is that no form of analysis is going to be 100% perfect all the time. And I'm never trying to come out there and say that I have all the answers. But I do try to look at markets as rationally as possible and try to look at the evidence in front of me. So certainly not claiming that I will get everything right. I've definitely missed this last recent pop here, this last $150 move in gold. But when I say that, I'm saying I'm missing it from a trading perspective. I own a significant amount of gold from lower prices. And so my backdrop has always been you should own a core position of gold, and then let's try to get the swings as best as we can. Sometimes we'll get those wrong. Most of the times we hope to get those right. So there's just two concerns that I hear often, and I just wanted to address those for your audience about this form of analysis that you're going to see. And one is that I hear a lot, people will say, you're looking in the rearview mirror. You can't hope to figure out what's going to happen in the future just by looking in the rearview mirror. And so what people are saying here really is that we're only looking at the past and that you can't derive information from the past. And I really want to challenge the listeners to think about this for a moment, to really stop and think about that idea that we can't learn about the future from the past. I would actually go so far as to say that every single projection, estimation, guess as to what is going to happen in the future, every single one comes from a study of the past, not just in the markets, but in all aspects of life. If you think about some things in the natural world around us, the stars, the movements of the stars, where does our knowledge come from about where the stars are going to move according to the different seasons? That comes from our observations of the past. When we look at weather, the 10-day weather forecast, or even the next day weather forecast, where does that information come from? It comes from what happened yesterday, a few states away, a few hundred miles away. Therefore, what are we projecting into the future? We look at the tides, tide charts. Where do we learn? Where do we know with such precision what the tides are going to be based on the study of the past? It's not just the natural world around us. Let's look at other human behaviors. Look at sports. For example, baseball. We talk about batting averages. How does a manager know to put a certain pinch hitter in a certain situation? It's based on his past performance, the batting average. You look at business projections, revenue estimations, client acquisitions. What is this based on? It's based on information from the past. Look at art. Look at movies. What movies do you want to see? What director do you like to see movies from? Based on what you watched in the past. So, I just want to say that I've thought about this, and I appreciate these objections that people bring up, because it actually really challenges me. It forces me to have to go back and think about things that I'm doing and think about, okay, how do I respond to that? And so my response to that one is just think about everything we do as human beings in the natural world and tell me what we're not deriving information from the past to project into the future. That's the first major sort of backdrop to this. Mm-hmm. The second one is people will say, as we're looking at various time periods throughout history, yes, but you're ignoring fill in the blank fundamental. You're ignoring the amount of debt, for example, or you're ignoring the unfunded liabilities. And it's a valid concern especially for individuals who come from the fundamental backdrop. But I want to just explain a little bit about how technical analysis works, the entire philosophy of this system of analysis. When you're telling me, what about X fundamental? What about fill in the blank fundamental? My response to that is going to be yes, but what about the infinite fundamentals? What about the infinite fundamentals that even you are not looking at? For example, the amount of debt may be something that drives certain individuals to buy gold. But what about the individuals that don't care about the amount of debt? And it's not that their reasoning for that is not, it's not that reasoning may or may not be rational. I would say if you're not concerned about debt, that is irrational. But we know that markets can move irrationally for extended periods of time. And so, for example, what about the fundamental of someone who has to sell all of their gold in an estate sale because someone died, and suddenly 1,000 ounces of gold come onto the local market? What about that fundamental? What about the central bank that simply decides to sell their gold because they're trying to raise reserves, such as what's happening in Venezuela? What about that fundamental? Every single human being who has a thought about the market represents a fundamental who decides either to buy or to sell. The point of technical analysis is to recognize that as individual human beings, we cannot, it's impossible to know all of the fundamentals. There is no way in God's green earth that we will ever know all of the fundamentals. So if someone is saying to me, what about this fundamental? It's like, yeah, that's one out of infinite fundamentals. The only place that all the fundamentals, including the ones that we know and the ones that we don't know, the only place that comes together is in the current price, including the manipulators. They have to sell at the current price, including the central banks. They have to buy at the current price, including the hedge funds, including the speculators, and including those quote-unquote uneducated individuals that have no idea what they're doing, but they just buy or sell anyway. all those fundamentals come into the current price. And that's why the philosophy of technical analysis is not focused on one fundamental. It's focused on price. The overarching philosophy of technical analysis is a recognition that as human beings, we cannot know all the fundamentals, and that by cherry picking 1 or 2 or 5 fundamentals, by definition, you are choosing that number over an infinite number of fundamentals, which is a very, if you ask me, a very haphazard way of evaluating the sum of what is impacting the markets.
So what would you say in terms of your percentage of decision making? I mean, based on technicals versus fundamentals, I mean, if you could give a ballpark estimation, how do you typically decide?
90% technical.
Wow. Well, that's probably why you brought us 5 slides that are technical based to cover today. So I figure that is a good place to probably jump into it and get off and underfoot.
That's great.
All right, great. So you brought this first slide. It's got the gold price from 2011 to present day. We could probably jump in there and start it off.
Yeah, so the reason I wanted to discuss this first slide is just to give people a very clear visual look of where we actually are since that peak in 2011. We had the big, the 4.5-year bear market to that end of 2015 low. Gold gave back about 50% of its former gains. And you could see the color key here for all these annotations. But the point that I want to make, because there's a lot of celebration happening now at this moment, as if we've already seen this base, which is really, it extends back to 2013, that we've already seen this broken out. And I would say that is not true. What I tend to see is that when people are using a real high-level chart, they'll just draw like a fat line, almost like a magic marker type of line from that 2013 zone all the way to the present, and they'll say, it looks like we've broken out. But if you really zoom in with as clear of a chart as possible, and I do hope these charts come clear for people to look at, you will see that although we have broken the 2016 high, that 2013 high, point number 1, labeled in red, was $1,434. And you can see that was clearly part of the resistance zone that gold has been challenging here. And so I would say, although the momentum is strong, and I, in fact, wouldn't be surprised if gold goes higher through that point number 1, it hasn't done so yet. So let's not call a spade until it actually is one.
Yeah. It's definitely clear on the chart, and I'll do my best to make sure it's an HD high definition for those that are watching this video on YouTube. For listeners out there, just simply listening on the podcast, that point, the fact that it hasn't cleared 1434 is explicit on the chart. So it'll be interesting to see if we can breach it, or if we'll have to back and fill for a bit, if we indeed breach it in the coming months, perhaps. Okay, slide 2, you've got, we get into the gold-silver discussion, gold-silver ratio, which is, like I said earlier, currently just over 92, which is a 30-year high at the moment.
Yeah, that's right. We're kind of getting into uncharted territory at the moment, based on the modern era, let's say the post-1999 or 2000 era. But do we have that chart up now? That's the gold to silver ratio going back from 1971. Is that the one that you have up?
Correct. 1971, 87, correct.
Great. So what I want to show people here, because I am cautious on the precious metals over the next 6 to 18 months. I am cautious based on, as we were talking about in the introduction, based on the technicals, based on a study of how these patterns have played out in the past and the striking similarities to what we are seeing right now in the present. So what I want to do, as I said, we have to study the past. We have to get models of what could happen, what has happened before, and then move to the present. So this is a 3-part chart, and I know on the video it's going to be tough to see all 3 parts at the same time, but we're looking at a top, which is the gold to silver ratio from 1971 through 1987. And in the middle, we have the price of gold, and in the bottom, we have the price of silver. And what's giving me, there's several internal divergences that I'm noticing in the precious metals right now, and we'll get to the present in a moment. But there's several internal divergences that are raising red flags in my mind as to the sustainability of any breakout attempt that we're getting now and any further advance over the next 6 to 18 months. So that's why I'm going to bring up this example from the past. Now, just as a side note, quickly, before we go further, although I'm cautious, please remember I own precious metals from lower prices. I think everyone should own some precious metals, given that 10% of my mind that still will concern with the fundamental backdrop. Could there be a sudden currency revaluation? Perhaps there could be. So everyone should own some precious metals. But what I'm talking about is for the person who is maybe 100% in the metals and they're looking to hit a major home run over the next 2 to 5 years. I'm raising some flags of caution, and then you have to decide what to do with that information. So just look at the gold to silver ratio, this example from the past, from 1971 through 87. And remember, we're talking about the freely traded era. This is post-1971, breaking of the Bretton Woods standard. And what I want to point to you is that the gold to silver ratio hit a peak in 1973. And you can see this, I'm labeling it here, all-time resistance zone. Okay, it's this black zone between about 42 and 47 on the ratio, number of ounces of silver to buy 1 ounce of gold. And if you look at that, we had that peak in 73, peak in early 75. You had the peak in 1980, okay, hitting 42 again. We had several peaks there in 81 and 82. We had a bit of a false breakout labeled in red in 1982. It quickly reversed back under that 47 level. And then we had another peak in 84. So in sum, we have a multi-decade resistance zone. And remember, for people who were investing in the precious metals in the 70s or the early 80s, for them, the all-time high for the gold to silver ratio was this region in the mid-40s. It had never gone beyond that, ever in the modern era of freely traded gold. So for them, they were looking at this and they were saying, especially imagine in the year 1985, 1986, okay, as the gold to silver ratio was exceeding 47, 48, and then it got above 50, right, in 1986. Mm-hmm. The average person at that point would have been saying the gold to silver ratio is at a level corresponding with previous peaks. Therefore, this is the highest it's going to go. Therefore, the reasoning would be that silver is a screaming buy relative to gold at this point. This is what I'm trying to raise a caution about, because when we see a multi-decade resistance zone here, like we saw from 73 through 86, okay, that black zone, when we see that clearly begin to be exceeded, that's telling us that the previously unthinkable is actually happening as far as that relationship goes, where now we move down and we look at, in the middle, the price of gold. So think about what was happening here. Gold had fallen from its 1983 peak at $525 per ounce. It had fallen almost 50%, all the way down to $275 in the beginning of 1985, okay? And then it began to claw its way back up. You can see that. By 1987, it clawed its way all the way back up, a 90% gain. Think about this for a minute. 90% gain. Imagine in 2019 dollars. That would be like gold moving from 1,000 back to 1,900. 90% gain. Just keep in mind what people would have been thinking at this point. Gold is approaching this base resistance zone. We just looked at that in the last chart. Yet, there's this major negative divergence happening, as we showed at the top, of the gold to silver ratio actually breaking out and not moving downward as it did in the previous decade of data. So we see gold clawing its way back up to 525. That looks like a beautiful cup base, right? Everyone's saying we're back to 525. We're about to break out. We're about to break out. Let's move back down to the lower part of this chart. And I just want to show you what happened with silver here. Then we'll fast forward this. Silver basically ignored the move higher in gold for the first 2 years. Look at that move from 1985 to 1987. Silver drifted lower as gold was advancing the whole time. And then silver had a 100% move higher in 8 weeks. Silver doubled in 8 weeks in 1987. A lot of people overlook that on the long-term charts because it's, when you're zoomed all the way out, it's actually hard to see. But imagine in today's terms, that would be like silver moving from $15.50 up to $31 in 8 weeks. Imagine today, people would be swinging from the chandeliers. They would be popping the champagne, celebrating in the streets that it's a new bull market in silver, right? This is the same percentage move that happened in 1987 as gold was approaching its peak.
Yeah, I'm just only laughing because it's so true.
I mean, and I would be doing that too if I was not studying these internal technicals that were saying, hey, wait a minute, could this be a giant fake out? Mm-hmm. I would be celebrating too, and the me from 2007, 2008, 2009 absolutely would be. But that's part of what led me in this direction to want to study these technicals.
Mm-hmm. Yeah. Okay. So should we back it out to a further distance, this chart?
Let's do it.
Okay.
Let's do it.
Great.
So chart number 3. Mm-hmm. Exact same 3 asset classes. The gold to silver ratio on the top, price of gold on the bottom. Price of gold in the middle, silver on the bottom. Except we're now extending that not from 1987, but now to the year 2000. Mm-hmm. So let's resume where we were. The gold to silver ratio was breaking out. We have that labeled in red on the top. Legitimate breakout. Okay, clearly exceeding all former peaks, not backing off, not being a false breakout, but just clawing its way higher as the price of gold was advancing. Very, very rare to see that, but it's actually a negative divergence. So look at what happened. Gold got its way right back up to the base resistance zone, 90% amplitude. That would be equal to gold getting back to 1900 today. And then what? It just stopped dead in its tracks, and there was 13 more years of a bear market. Silver, at the very bottom of the chart, there's that doubling, right? Everyone's saying bull market, silver has doubled. 13 more years of declines. Mm-hmm. So I'm just bringing up the historical example to ask you, I'm trying to ask people to think in their own minds what they would have done if they had seen silver double in 8 weeks, or they had seen gold rise from 1,000 to 1,900 in today's terms. Would they have been willing to step back for a minute and say, wait a minute, actually, could this represent an ideal time to sell as opposed to a time to chase the move higher?
Mm-hmm. Mm-hmm. Yeah, I mean, such is the point, right? It's always having a prudent allocation to precious metals, right? Not going all in at any one asset class because of things like this. Obviously, in 1987, you had a huge panic on Wall Street. I'm sure there's a lot of people still thinking twice about the fiat currency, the underlying reserve currencies of the world. So yeah, there was those arguments, the same age-old arguments were being made then as they are now.
For sure. Mm-hmm. And so just to get back to that kind of introductory point on this, my presenting of this evidence here is never to tell any particular person out there that you should, for example, consider selling all of your precious metals. Never. I'm never saying anything like that. Mm-hmm. I think the prudent investor today always has at least a base allocation Even if that means chasing or averaging in at these prices a little bit after this move in gold, you got to have some, because what if it is that one black swan that we can never predict,
Right.
like what happened in 1933 when gold was confiscated and revalued overnight. What if we do have something? You have to have some exposure, but there's a big difference between maybe having a core holding and then saying I'm going to be 100% invested, especially on margin and with leverage, which, let's be honest, guys, I know there are some of you out there who fit into that camp. It's especially people like that are 100% in the precious metals and not wanting to acknowledge the internal red flags that we're seeing that I'm speaking to at this point.
All right, great. So do you want to move to the next chart? I think it's more closer to today, correct? 2002 to present?
Great.
Sure.
That'd be great. So this entire backdrop, right, we talked about this in the beginning, studying similar examples from the past. We have to base future projections on similar data points from the past. Here's the gold to silver ratio, the exact same three asset classes, three charts, one on top of the other, just 2002 to the present. And we have a strikingly similar technical scenario setting up here. Despite the fundamentals that I agree are different than in 1987, despite the fundamentals that I know of and the fundamentals that I don't know of, we have the same, almost the exact same technical setup here, which is that there is this multi-decade resistance zone. Now it's between 80 and 84, and you can see that on the upper chart in black, the multi-decade resistance zone, where previous times, 2003, 2008, the crash of 2008, 2016, each of the previous times that the ratio has gotten to this level have represented excellent buying opportunities for both metals because the ratio has compressed, silver has outperformed gold, and both metals have moved higher. However, something different is happening now. And this is the exact same red flag that appeared there in 1986 leading up to that peak in 87, where the gold to silver ratio, as we talked about, is breaking out. It's breaking upward. It's not breaking down. And so, and it's not just that, for example, we could say, oh, well, silver tends to lag during the beginning of a bull market. That may be true, but it certainly didn't lag from the move off the 2015 lows. And that was the beginning of theoretically what people are thinking is a bull market now. So silver didn't lag in the very beginning at all. In fact, it outpaced gold on that 2016 move. So why is it lagging here in what we would call round two or inning two, to use the baseball analogy? So we're seeing that red flag in the gold to silver ratio. Once again, think back to that analogy from 1987. When was the ratio breaking out? Exactly when gold was trying to break that base resistance zone. So moving into the middle chart, and we can see gold is at that base resistance zone. The only difference here is that this amplitude from 1045 at the 2015 low up through 1430, where we are today, plus or minus on Tuesday, that only represents about a 40% amplitude. The example from 87, as I said, much more dramatic. If you can imagine that gold gets back to 1900 and then tops for the next 13 years. That's the example that happened in 1987. And then moving down to the very lower part, we have silver basically performing exactly the same as it did in 85, 86, basically ignoring the move in gold. And it leads me to wonder if we are not setting up for some sort of a dramatic, again, can we imagine silver doubling over the course of 8 weeks or so? Maybe not right now, but maybe a few months from now. Can we imagine that doubling and then it just stopping in its tracks? This is exactly, from a technical basis, we're seeing these warning signals. And the other thing that I would say is we're seeing these warning signals about 7 to 8 years after a major peak. The major peak in 2011, and now here we are, 2019. That's about an 8-year period. Think about when this exact signal happened with respect to the last precious metals peak in 1980. That was also 7 to 8 years after a major peak. So will this exactly repeat as it did in the past? Probably not. Are there some significant warnings here that the average person who's just chasing the nominal price should be aware of, especially if they're considering going all in or chasing the prices higher? Yes, you absolutely should be paying attention to these negative divergences.
Now, with the gold-silver ratio at 92, I'm seeing you got this target equals 138 up there. I think the all-time gold-silver ratio high was like 105 roughly in the Great Depression, right? In the mid-1930s. I think silver prices got down to as low as 25 cents an ounce in the Great Depression. It's probably the peak of the gold-silver ratio. I'm guessing the target that you have up there is based on technical analysis, the amplitude or something along those lines?
Yeah, that's exactly right. Great data point, by the way, from the Great Depression. Of course, the caveat we have to say there is that gold prices were officially manipulated, not just covertly, but overtly. And but that's very interesting. So this amplitude, I showed this, by the way, on the second chart. Going back from that example from 1971 to 1978, how the amplitude of that big dip leading up to the 1980 peak was actually an amplitude of 30. And in technical analysis, when you have a very clear swooping type of consolidation with a defined amplitude below a multi-decade resistance zone like that, one of the ways to calculate a projection for the break higher is to add the widest amplitude onto the highest part of the base. And just remember from the 1980s, the mid-1980s, so this move which would project 30 above 47, this would have been unheard of at the time, at least in the modern freely traded era. Everyone would have been saying, you're crazy. Gold to silver ratio has never gotten above 47, 48. It's never done that in the freely traded era. You're projecting to 77. That's crazy, right? But sure enough, by 1986, that ratio hit 76, almost smack on. So what we're saying now is that we are seeing the exact same breakout happen. And the same calculation can be used in a highest probability sense to measure what type of move we should be expecting, plus or minus, over the next several years, which would be 138. In other words, it's 84, the previous resistance zone, plus that amplitude, which again, just think back to the 86, 87 example. Everyone would have been saying, you're crazy. This has never happened before, but we are seeing it in the initial stages now.
Yeah, I mean, a 138 gold silver ratio is a lot of towels would be tossed by then. I would imagine people would just totally quit. Others would just be buying more and more. So it would be a very weird situation if we ever got that high. But I certainly have not. I've been pretty explicit in our latest Metals and Markets podcast that I wouldn't be surprised to see over 100 before silver maybe starts coming back in line in terms of the typical gold silver ratio, maybe strengthening after that. But 138 is indeed very high. And yes, like you said, in the 80s, had you said 76, 77, based on that technical analysis, a lot of people would have said you were crazy.
Yeah. And one other thing that I wanted to say. So one of the things you always do as a technical based analyst is you have to identify points where you admit that the market has changed. And in other words, where the previous projection is wrong. Just to say that again from the top of the hour as we began, I'm never saying that I have the 100% truth. What I'm saying is that I have probabilities based on visible data. And so the point here where the gold to silver ratio, where it would show me that this analysis is wrong, like for example, let's say it gives us a fake move, like here it is, it's surging. Let's say it gets up to 98 or 100, and then we have something that looks like a major reversal back lower. If we could close back below that 80 level, the bottom of that multi-decade resistance zone, if we could do that, it would say that we've just had one huge fake out and silver's ready to lead this move again, perhaps for the next several years or 1 or 2 decades, even. That would be the point. So as a technical analyst, I look for what is the point that tells me where I'm wrong. I have no problem admitting if the market shows me something else, but should we not place the bias with what we see in front of us, and let's wait to call the analysis negated until we actually see that?
Yeah, that's a good point. The final slide that you brought along, it is reflecting the S&P stock index to gold ratio. It's basically S&P 500 divided by the price of gold. You have it backed out from 1999 all the way to present.
Yeah, and this would be what I am thinking is if my negative scenario comes to play, which is that gold tops out either here or perhaps it gets even more dramatic and gold starts rising into the 15, 16, 1700s over the next half a year or so. But let's say that it tops out in a similar way and that gold to silver ratio is warning us ahead of time as it did in the 1980s. Let's say that scenario ends up being correct. This is my hypothesis for what the fundamental reasoning would be for that. It's not that I disagree that the Fed is printing money the whole time. I know they're going to print money. It's not that I would disagree that there's, maybe they're lowering interest rates or there's unsustainable debt. I think all those things are going to happen. But the fundamentals, quote unquote, and again, this is my attempt to approximate the fundamentals. As a technical analyst, I believe I can never know all of the fundamentals. But one of the strong fundamentals would be that there is some sort of a final mania that sets up in the stock market. We haven't brought up the stock market chart here alone. There are several fundamental data points that show us that the stock market is already overvalued. Dividend yields, price to book ratios, margin, debt levels. Yet, when we look at this chart and we look at the historical peaks of the stock market relative to gold, what this is showing us is that the stock market can get a heck of a lot more overvalued than it already is, significantly so. If you look at where that peak was from the year 2000 and where we are today, and there's something of a 7-year trend that has been proven successful, and thus far we have nothing other than a consolidation. So once again, it's not to say that I agree with these fundamentals. It's not to say that I think one should necessarily be entirely invested in stocks and forget about the precious metals. I am not saying that at all. What I'm saying is that the evidence shows us that stocks can indeed irrationally get a whole lot more overvalued than they already are. And that would be something that I'm looking at to help explain fundamentally the warning signals that I'm seeing here in gold and especially silver.
Yeah, I think we were recently just at all-time highs again in the S&P 500. So and there have been plenty of people out there I've listened to who've talked about eventually there may be flight to safety in the U.S. stock market, and there could be an even higher bubble than currently is. So this is not to pour water on people's heads and put down the excitement, the fact that gold has shown some momentum of late. It's simply to challenge thinking a little bit, and I'm glad that you came on today, Chris, to do that and help us think this through. That's
exactly right. There's plenty of people. You don't have to look very far to get the super high gold and silver projections. It was my observation that there was not a whole lot of visible evidence-based counterpoints to some of those very high projections. And so that is what I try to provide here.
Great. Well, Chris, if people are listening and they want to follow you, I know you do some free videos on YouTube every other week or roughly every week. You have a good following there, and I enjoy those videos. I check them out often. How can people find you? What are your websites? What's your handle on YouTube, etc.?
Thank you, James. The main website is the letter I and then goldadvisor.com. That is the main website. We have a premium service that contains analysis like this, but actually significantly more depth. And here we're looking at one of the red flags that we look at, the gold to silver ratio. We look at about 5 different signals that are all aligning to attempt to gauge these probabilities. And we publish exactly what we're doing here with our own capital. So that's iGoldAdvisor.com. And then I'm launching a new site. This should be up in July. It's the letter I again, and then Global Analytics. And the reason for that is that I am legitimately concerned about these technical points that I'm seeing. And for myself, I want to begin to identify other asset classes. It's like this. It's even if perhaps someone who's 100% invested in the precious metals, if you agree, or if some of these data points that we've brought up today resonate with you, that there might be reason to consider taking some off the table at some point over the next 12 months, this doesn't necessarily mean that you just sell precious metals and put into fiat. There's plenty of other tangible asset classes out there that one could diversify into. So I'm not jumping into the belly of the Federal Reserve here and saying buy U.S. dollars. So the new site is going to be geared. iGlobal Analytics is going to be geared toward identifying major trends in about 10 different commodities, as well as the stock market, the bond market, and some currencies, so that we can be overall better prepared for some of those moves.
Well, that would be very helpful, because I think people have seen the chart before when you're looking at the S&P versus the Goldman Sachs commodity index. I mean, commodities are at some of the lowest points they've been in the full fiat currency era. So not simply precious metals, versus the S&P. They're very low at this moment, but so are many other commodities. So if we do have a change in the cycle where real tangible things start becoming more valuable, it will be helpful to at least get some insights into other asset classes. So I'm sure people will enjoy your site. Yeah,
and it's coming. That what you just talked about, the Goldman Sachs chart, S&P, compared to commodities, is such a great chart. I don't know if you have a chance to throw that up here, but but it's so great, and because these are things that can't go to zero, and they are basically the lowest that they've been valued as a net sum in 45 years. And so there's certainly going to be some very interesting opportunities, I think, not just 6 or 12 months opportunities. I'm thinking over the next 2 decades, after the stock market tops, there could be a multi-decade reversion to the mean in other real assets. So, that's a great point.
Well, Christopher, on behalf of our listeners, I definitely want to thank you for coming on and giving us some of these viewpoints that you had, and I appreciate it, because it's good food for thought.
Thank you very much, James. Best to all the listeners, and thanks again for having me.